Ever wondered if those spare dollars jingling in your digital pockets could actually grow into something substantial? 6 months ago, maybe you downloaded Acorns on a whim, intrigued by the idea of effortless investing. Now, you're likely curious, did it actually work? Did those automatic roundups and strategic portfolios make a real difference? Well, you've landed in the right place because today, we're diving deep into exactly that. What kind of results can you realistically expect after 6 months of letting Acorns do its thing? Before we get into the nitty-gritty of potential returns and what factors influence them, let's quickly recap what Acorns is all about for anyone who might be new here or needs a little refresher. At its core, Acorns is a micro-investing platform designed to make investing accessible to everyone, regardless of their financial knowledge or the size of their initial capital. Its most popular feature is the roundups tool, which automatically rounds up your everyday purchases to the nearest dollar and invests that spare change into a diversified portfolio of exchange-traded funds, ETFs. These ETFs are carefully chosen based on your risk tolerance and investment goals, ranging from conservative to aggressive. Beyond roundups, Acorns offers other ways to boost your investments, such as recurring daily, weekly, or monthly contributions. They also have a found money feature, which partners with various brands to invest a percentage of your purchases back into your Acorns account. And for those looking towards the future, Acorns offers retirement accounts, Acorns Later, and checking accounts with investment features, Acorns Spend. So, you've been using Acorns for 6 months. You've probably seen those small, almost negligible deductions from your bank account, those little contributions trickling into your investment portfolio. But what does that actually translate to in terms of tangible results? The answer, as with any investment, isn't a simple, one-size-fits-all number. Your individual results after 6 months with Acorns will depend on a variety of factors, and understanding these factors is key to interpreting your own progress. One of the most significant factors is your chosen portfolio. Acorns offers 5 core portfolio options: conservative, moderate, moderately aggressive, and aggressive. These portfolios are built using low-cost ETFs that invest in a mix of stocks and bonds. Conservative portfolios typically have a higher allocation to bonds, which are generally considered less volatile but offer lower potential returns. On the other hand, aggressive portfolios are heavily weighted towards stocks, offering higher growth potential but also carrying more risk. If you opted for a more aggressive portfolio 6 months ago, and the market has performed well during that period, you're likely to see a higher percentage gain compared to someone in a conservative portfolio. Conversely, during periods of market downturn, a conservative portfolio might hold up better, experiencing smaller losses. Another crucial element is the amount you've invested. This might seem obvious, but it's worth emphasizing. Someone who consistently invests $5 a week through roundups and occasional small contributions will naturally have a smaller total investment and, consequently, smaller absolute returns compared to someone who regularly contributes larger sums or takes advantage of features like recurring daily investments. The power of compounding, where your earnings start to earn their own earnings, takes time and a larger base to truly demonstrate its magic. So, if your roundups average a few dollars a week, don't expect to see hundreds of dollars in profit after just 6 months. It's a marathon, not a sprint. Market conditions during the past 6 months have also played a vital role. The stock market can be unpredictable in the short term. If the market experienced a significant upward trend during your first 6 months with Acorns, your investments would have likely benefited, regardless of your portfolio allocation. However, if the market faced a downturn or remained relatively flat, your returns might be modest or even negative. This is a normal part of investing, and it highlights the importance of a long-term perspective. Acorns is designed for gradual, consistent growth over years, not overnight riches. Beyond these core factors, your engagement with the found money feature can also influence your results. If you actively used partnered brands and made purchases that triggered found money investments, this would have added to your overall invested capital and potentially boosted your returns. Similarly, if you made any one-time contributions, these would have a more immediate impact on your account balance and potential gains. Now, let's talk about some realistic expectations. While it's impossible to give a precise figure without knowing your specific situation, we can look at historical market averages to get a general idea. Historically, the average annual return of the S&P 500, a common benchmark for stock market performance, has been around 7 to 10% before inflation. However, this is an annual average, and 6 months is a relatively short time frame in the world of investing. Therefore, expecting a double-digit percentage return in just 6 months, especially with smaller, consistent contributions, is generally unrealistic. A more likely scenario, assuming a moderately performing market, might be a return in the range of 1 to 5% on your total invested amount. For someone who has invested a few $100s over 6 months primarily through roundups, this could translate to a few dollars to perhaps a few tens of dollars in gains. It's crucial to shift your focus from the absolute dollar amount gained in the short term to the process and the foundation you're building. After 6 months, you've established a habit of investing. You're participating in the market, even if it's in small increments. Your money is working for you, however modestly, instead of sitting idle. This is a significant first step towards building long-term wealth. To get a better understanding of your specific results, open your Acorns app or log into the website. You'll be able to see your total invested amount, your total gains or losses, and the performance of your chosen portfolio. Look at the percentage return as well as the absolute dollar amount. This will give you a clearer picture of how your investments are performing. Don't be discouraged if your 6-month returns aren't earth-shattering. Remember that consistency is key. The beauty of Acorns lies in its ability to automate the investment process, making it easy to gradually build your wealth over time without requiring active management or large sums of money. As you move forward, consider ways to potentially amplify your results. Could you increase your roundup multiplier? Even bumping it from 1x to 2x can make a noticeable difference over time. Are there opportunities to utilize the found money feature more frequently? Could you set up a small recurring daily or weekly contribution in addition to your roundups? Even small, consistent increases can have a significant impact on your long-term growth due to the power of compounding. With that said, thanks for watching and until next time.